Hello traders, Gary Wagner here. It is approximately 7:30 and we are recording from the Mediterranean Sea on the 30th day of December, Friday. And this is the daily report, our weekend review and final forecast for the calendar year of 2011. Traders, there can be no doubt that this year went by extremely quick. We witnessed some of the craziest volatility in the market. Now that the market has finished trading and we have a fixed price for the conclusion of 2011, we can certainly see the kind of activity that we've seen when we consider that the low that it hit right in the beginning of February, right here, was in the low 1300s, 1303. As you can see, this is a daily Henkin chart. It went to a high of almost 1920, call it 1920, 1919, before beginning its downward correction. Quite interesting. In terms of an intermediate count and the wave count, the way I looked at it was we had 1, 2, 3, a very, very long triangle 4, and an incredible peak when we saw 5. Then, of course, our A, our B, and our C, which we are currently in. The question that we are going to want to answer, of course, is have we concluded this correction, or is there a little bit more downside possibly to go? Because the good news is, once we have weathered this correction, we will then begin the cycle all over again, starting with a new impulse phase. That impulse phase will be a total count, of course, of 5. 1, 2, 3, 4, 5, as you see here. And in terms of the major count on top of this, my count shows me at 3 here. This would be 4. And so what we will witness at the conclusion of C and the onset will be our last primary impulse wave, which will be a major 5. And if the major 5 is anything like what we experience on this last intermediate 5 up here, traders, we are in for one upside move in the gold market. And as you are probably aware, I am forecasting gold to run as high as $2,000 next year. I would look for a repeat of this cycle. The big question, of course, becomes, have we seen the last of this correction? Now, when we take a look at this market in a long-term manner, what you will see is that typically over the last few years, and let me see if I can compress that for us, over the last few years, we have had this correction kind of peak out here. We've got October, so November we get our high. And then once this market goes to the high here, this is 2010, of course, right around February, we begin again, and that takes us all the way up to this high, and then once again we get our correction. So we have seen this happen before. If we look at 2009, really a similar activity. We had 1, 2, 3, 4, 5, and the market came down. The question you need to ask yourself is, have the fundamentals in the market changed so drastically that we are moving out of a bull market into a sideways or bear market? My contention is that no. There has not been much news about the European Union and the sovereign debt crisis, but I would expect that to kind of heat up again in 2012. So traders, I believe dynamically we could see this market really take off and of course go to new record highs. Now, if in fact the count that we are looking at is correct, and we've gone to an ABC, more importantly on our major count, if our count is correct and we're at 3 and then 4, of course, our fifth wave moving up has to, by the virtue of Elliott wave, go to a new high. You're not going to have a fifth wave here that, unless it's a highly truncated wave, that does not exceed this 1919 that we saw at the conclusion or peak of this rally. So we are really looking at some very interesting possibilities. Now, there's a couple of very, very simple strategies to kind of give us an idea of where we're at and where the market might go. The first question we have to ask ourselves is, has C concluded? And that's a $64 million question here, because if this particular correction, this A, B, C, is what is simply known as a flat correction. A flat correction is where you have approximately equal lows on A and C. We're certainly not going to see a truncated, because that would be above the low that we saw here. We would get a higher low, and we haven't gotten that. So it's either going to be obviously a flat, or it would be what's called a standard zigzag. Now, on a standard zigzag, we would get a new low. And my expectation would be, if that in fact happens, in other words, if we get our A, our B, and we get a standard zigzag, I would look for this market to possibly have one more really correction, finalizing the correction down. And in terms of price structure, it could be as low as 1448. Technically, that's absolutely possible, and in many cases, a standard zigzag is something that we'll see more times than not. If in fact we are close to the bottom, the easiest way to look at it is within this final C wave. I had been anticipating a 5 count, meaning 1, 2, 3, 4, and our 5th wave down. One of the standard rules of thumb, and of course it certainly does not apply when we consider the upside move here in wave 5, but one standard calculation is that typically, and by all means we're not looking at a typical market, but typically you will have your wave 1 and wave 5 be approximately equal. So all I've simply done is taken this first of 1, and I'm simply going to extend it and move it down. If that is the case, and again, we'll have to see, we would be looking at a conclusion, even, and this still would be considered close to a flat, a conclusion at around 1510, 1513, as you can see right in here. So if we're going to get a standard, it could go as low, as I said, as 1440, 1448. If we're done with the trade, in other words, if the market's going to begin to move up, we have absolutely completed what would be necessary for a straight flat correction, meaning our ABC, and we have our C pretty much equal to the low of the A. Now, where might this market go? And of course, that's another big question. Now, if we were to see a rally that was equal to the rally that we saw this year, and that's a big if, but I'm just postulating one of the possible variables. And what I'm going to do, of course, is I'm going to extend this line, and I'm also going to extend it based upon the assumption that what we see is this market continue to correct to that 76% correction, meaning down around 1448, extend it over, and even with that low, if we get a rally that's equivalent to that, traders, we could see this market go again above 2000 to 2050, just below 2100. That's certainly not out of contention, and it is absolutely a possibility within the market. As I said, we'll have to see how this market wants to trade through the next year. I can tell you this, though. I can promise you one thing. We had an incredibly exciting market in 2011, and I see no reason, based upon the fundamentals, that that's going to change in 2012. Traders, have a great, prosperous, healthy, and happy new year. Bring in 2012 with a bang. Realize that the gold market went in like a lion and out like a lamb, and at some point it's going to turn back into the lion again. Traders, this has been Gary Wagner, wishing you as always good trading. Have a great new year, and following this will be an interview that I did for Bloomberg TV, Money Moves, their show on the 28th in New York City. Have a great day. Bye-bye.
Our next guest is one of the world's leading metals experts. He's a technical analyst, has been for more than 25 years. He has specific views on where gold, silver, and oil are headed. Gary Wagner is here now. He is president of Wagner Financial Group. He also writes the goldforecast.com newsletter. Gary, thanks for joining us here on Money Moves. So gold has really had a standout year. I mean, before today, it was up around 10% this year. The past decade, it's really been a haven with all the volatility that we've seen, especially the credit crisis. Where does it go in the new year?
Well, what I'm looking for in terms of market timing right now is if we look at the last 3 years, we've seen rallies that have taken the market to record highs approximately to October or November. From that point, it typically had sold off and bottomed somewhere between January and February of the following year.
So why do you think this is linked to a calendar?
Well, I'm just looking at the market moves themselves and the cycle itself. I'm more an Elliott wave technician, so what I'm looking at is the fact that although when we see gold, it has risen for 11 years, it's produced very good results, almost double-digit this year. But when the market sells off, we have to see a technical approach and look at a technical approach to get an idea of targets of where that market might sell off to.
So what are you looking at now next for the next level of support?
Well, we broke 1580, so the next level is going to be 1534. 1534 was the low that it hit on this last dip. If it holds support there, then we'll go into an extended rally. If it cannot, the lower target below that is 1440.
Now, on the other side, if you were to take the bullish argument, just how high can gold go in 2012?
Well, I'm projecting that it will make a new record high, and our old record high this year was 1920. I'm looking for $2,000 gold through next year and the next rally.
And then you say we're going to see a correction, right?
That is correct, yes.
And why is that?
Well, the markets don't tend to move straight up or straight down. We can look at the fundamentals involved, and right now one of the main targets is that strong U.S. dollar and the fact that the consumer confidence has gone back up in the United States. But irregardless of what the fundamentals behind it, there seems to be a pattern or a natural cycle in which gold has been moving if you chart it over the last 8 to 10 years.
So essentially you're using a combination of fundamental analysis by following the trends, and then you're charting these moves, and so you're just analyzing what you see in the charts.
Exactly. I look at myself as a hybrid technician, and then I look at the fundamentals for my underlying bias. And my underlying bias right now in gold is bullish. But in terms of the peaks and valleys, the ebbs and flow, I need to look at my charts and the technical aspect to look at where the market might go to.
So you do think $2,000 an ounce is easily achievable in the first 6 months of next year?
I don't know about the first 6 months, but I would say by the end of 2012, we should see our rally peak out, because the rallies we've seen over the last 3 years have peaked between, well, it was September on this one, but it's been October and November on the prior years.
How do you see silver? A lot of people call it the poor man's gold. Do you think silver will trade more or less in tandem, pattern-wise, with gold?
Pattern-wise, absolutely. It tends to follow gold, and it also has the unique variable of being an industrial metal. So when you have a forecast that's bullish in terms of the global equities markets, you will see silver outperform gold in terms of percentage gains. But it will move in tandem with gold.
Can you give us a price? How high could silver go in the new year?
You know, I'm looking for it just to go back to the recent highs. It hit $49. I would be satisfied seeing $40 to $42 silver.
I know you're also charting oil. You've done an equal amount of research with oil as you have with gold and silver. Today is the first day lower in 7 for oil. We were just hearing from Zara Burton on that. Where do you see oil going?
Well, you know, I think that it will probably find support at 100 and begin to trade off of that.
Fundamental reasons. We heard Zara talking about the Straits of Hormuz, some of the more aggressive statements that Iran was making. How much does that factor into where you see prices going?
Oh, it factors into it a lot, but you also have scenarios like when the tsunami hit in Japan, the price of oil in the Asian basin just skyrocketed, and the global need for oil continues to rise. And anytime you look at supply and demand continues to rise, demand continues to rise and supply stays about the same, you're going to get a scenario of increased prices.
Some analysts have said the U.S., believe it or not, will become more and more self-sufficient. There's going to be more and more drilling in the Gulf of Mexico. Do you see that happening? Do you agree with that? Is that what you're hearing as well?
I would see, as oil gets more expensive, it makes more sense to do the types of drilling sites that take more capital to initially undertake.
Okay, Gary, we thank you very much.
Oh, it was my pleasure.
Joining us there, Gary, of course, is a chartist, and Gary Wagner, I should say, president of Wagner Financial Group.